What is contrarian investing? Contrarian investing is a strategy that involves deliberately going against prevailing market trends. This includes buying assets that are performing poorly and selling those that are performing well. To understand this better, let's visualize how contrarian investing works in the market. Markets often overreact to news and events, creating price movements that eventually revert to the mean. Here we see a typical market cycle. The market begins with a steady trend. Then, due to negative news or market sentiment, prices drop dramatically, often in an overreaction. This is where contrarian investors step in, as they believe the market will eventually recover and revert to its mean. The contrarian investor buys here when everyone else is fearful, and sells here when sentiment has improved and others are buying again. This creates a potential profit zone where the contrarian investor capitalizes on the market's reversion to the mean. The core philosophy of contrarian investing is based on two key principles. First, markets often overreact to news and events, creating excessive price movements. Second, market sentiment eventually reverts to the mean, creating profit opportunities for those who positioned against the crowd. As Warren Buffett, a famous contrarian investor, said, "Be fearful when others are greedy, and greedy when others are fearful." This mindset forms the foundation of the contrarian investment approach. Contrarian investing is deeply rooted in understanding human psychology and how it affects financial markets. Investors often exhibit several behavioral biases that create market inefficiencies, which contrarian investors aim to exploit. Herd mentality occurs when investors follow what others are doing rather than conducting their own analysis. Overconfidence leads investors to overestimate their knowledge and ability to predict market movements. Recency bias occurs when investors give too much weight to recent events, ignoring longer-term historical patterns. These psychological biases lead to market inefficiencies, creating opportunities for contrarian investors. Let's visualize how market prices can deviate significantly from intrinsic value due to these psychological biases. During periods of optimism, prices can rise far above a security's intrinsic value, driven by greed and overconfidence. Conversely, when negative news causes panic selling, prices can fall well below intrinsic value, creating buying opportunities for contrarians. Contrarians capitalize on these psychological patterns by maintaining emotional discipline and making decisions based on fundamental analysis. Let's compare how emotional investors and contrarian investors behave in the market. To summarize the psychological principles behind contrarian investing, market psychology creates persistent inefficiencies. Extreme sentiment often signals potential turning points. Contrarians profit from psychological overreactions, and emotional discipline is essential for contrarian success. Remember, understanding market psychology is the foundation of successful contrarian investing. Let's explore some of the most famous contrarian investors in financial history. Warren Buffett is perhaps the most famous contrarian investor. As chairman and CEO of Berkshire Hathaway, he's known for his timeless wisdom. His famous quote encapsulates the contrarian mindset: "Be fearful when others are greedy, and greedy when others are fearful." Buffett demonstrated this approach by buying heavily during the 2008 financial crisis, avoiding the tech bubble in the late 1990s, and making a critical $5 billion investment in Goldman Sachs when markets were in panic. Sir John Templeton, who lived from 1912 to 2008, was a pioneer of global investing and one of history's greatest contrarians. His most legendary contrarian move came during the Great Depression. In 1939, Templeton borrowed $10,000 and bought 100 shares of every stock trading under $1 on the New York Stock Exchange. Despite 34 of the 104 companies going bankrupt, he quadrupled his money in just 4 years. David Draymond, born in 1936, pioneered quantitative approaches to contrarian investing. His systematic contrarian strategy focused on identifying undervalued companies through precise metrics. Draymond founded Draymond Value Management and authored the influential book Contrarian Investment Strategies. His approach focused on companies with low price-to-earnings, price to book and price to cash flow ratios. Using this methodology, he outperformed the S&P 500 by an impressive 8% annually from 1977 to 1997. Michael Burry, born in 1971 and founder of Scion Capital, executed perhaps the most famous contrarian trade of the 21st century. His story was immortalized in the book and film The Big Short. In 2005, when housing prices were soaring, Burry identified severe problems in the subprime mortgage market. He took a massive short position against mortgage-backed securities, facing intense criticism and investor withdrawals for nearly 2 years. When the market finally crashed in 2008, his fund returned an astonishing 489% net of fees. Despite their different eras and strategies, these legendary contrarian investors share several common traits. They all possess psychological fortitude to withstand criticism and conduct deep research that gives them conviction in their analysis. They demonstrate patience to wait for market recognition, comfort with short-term volatility, and an unwavering focus on long-term fundamental value. This cycle illustrates how contrarian investors buy when markets are fearful and sell when euphoria takes over, allowing them to achieve superior long-term returns. Contrarian opportunities emerge in sectors experiencing widespread pessimism. These opportunities often appear when market sentiment is extremely negative and prices have declined significantly. Several key indicators help identify potential contrarian opportunities. High short interest indicates widespread bearish sentiment. Negative analyst coverage often peaks near market bottoms. Historically low valuations provide a margin of safety, and institutional selling can create price dislocations. Technical indicators like the Relative Strength Index can also signal potential contrarian entry points. When RSI falls below 30, the asset is considered oversold, potentially indicating a buying opportunity. The best contrarian opportunities typically arise when solid companies are temporarily dragged down by broader market or sector-wide concerns. Look for businesses with strong fundamentals despite price declines, companies outperforming peers even while their entire sector is out of favor, and those whose long-term viability remains intact. By focusing on these indicators, contrarian investors can identify potential opportunities when others are fearful. Contrarian investing techniques employ specific methods to capitalize on market inefficiencies. Value averaging is a disciplined approach where investors commit more capital as prices decline. This technique allows you to buy more shares at lower prices, enhancing long-term returns. A core contrarian technique is buying beaten-down sectors with strong underlying fundamentals. While others flee these sectors due to temporary challenges, contrarians identify long-term value opportunities. Contrarians often look for stocks with high short interest. When a heavily shorted stock starts to rise, short sellers may be forced to cover their positions, potentially creating a short squeeze that dramatically increases prices. Contrarians often monitor sentiment indicators to identify extreme pessimism in markets. When fear is at its peak and sentiment indicators reach extreme lows, this often signals a potential buying opportunity. Many contrarian investors use quantitative screens to identify securities trading at significant discounts to their historical valuations or peer groups. This data-driven approach helps find potential bargains in the market. Beyond numbers, contrarians conduct thorough, qualitative analysis. They look for companies with strong competitive advantages facing temporary setbacks. By distinguishing between short-term challenges and fundamental business deterioration, they can identify opportunities others miss. These contrarian techniques provide a systematic framework for finding investment opportunities when others are fearful. By combining these approaches, investors can build a robust contrarian investment strategy. Contrarian investing carries significant risks that must be carefully managed. The biggest danger is the falling knife scenario, where an asset continues declining after purchase. Markets can remain irrational longer than investors can remain solvent, as Keynes famously noted. Contrarians must distinguish between temporarily undervalued assets and those facing fundamental, irreversible decline. This strategy requires considerable emotional fortitude, as positions may underperform for extended periods before thesis validation. Proper position sizing and diversification are essential risk management tools for contrarian investors. Building a successful contrarian investment strategy requires combining careful analysis with psychological awareness. Let's explore the 5 key components of an effective contrarian strategy. First, establish clear criteria for identifying undervalued assets facing negative sentiment. Look for strong fundamentals despite market pessimism, significant price drops relative to historical averages, insider buying, and excessive pessimism in analyst coverage. A successful contrarian identifies opportunities when prices drop significantly below intrinsic value due to market pessimism. This creates an entry point with favorable risk-reward characteristics. Second, determine appropriate position sizes that allow holding through volatility. Size positions according to conviction level, but ensure you can withstand turbulence without panic selling. Consider inverse correlation to your existing portfolio, and typically limit individual positions to between 2 and 5% of your total portfolio. A well-constructed portfolio includes contrarian positions that are appropriately sized relative to your risk tolerance. Contrarian positions should be large enough to impact performance when correct, but not so large they threaten your financial security if temporarily wrong. Third, set specific valuation targets for both entry and exit. Establish quantitative criteria for entry, such as price to book or price to earnings ratios below historical averages. Define clear price targets for exit. Consider both absolute and relative valuation metrics, and be prepared to reassess if fundamentals change. Successful contrarians define specific metric-based targets before entering positions. For example, you might look for PE ratios below 12 for entry, with plans to exit when they reach 20, significantly below the market average of 22. Fourth, maintain a diverse portfolio to manage risk. Balance contrarian plays with more stable investments. Diversify across different sectors and asset classes. Consider the correlation between your holdings and avoid overconcentration in a single contrarian thesis. A well-diversified portfolio might include contrarian overweights in sectors like energy or materials that are temporarily out of favor while maintaining exposure to other sectors for balance. It may also include contrarian underweights in overvalued sectors. Finally, develop the emotional discipline to act when opportunities arise, even when it feels uncomfortable. Cultivate comfort with being temporarily wrong. Document your investment thesis before entering positions. Set rules for reassessing, not abandoning positions during volatility, and practice patience during inevitable periods of underperformance. The greatest contrarian opportunities emerge when prices are falling and negative sentiment is at its peak. This is precisely when most investors are panic selling and when emotional discipline is most crucial. The gap between price and sentiment creates the opportunity. Successful contrarian investing requires a systematic approach, combining rigorous analysis with the courage to act against prevailing wisdom. By establishing clear criteria, proper position sizing, specific valuation targets, portfolio diversification, and emotional discipline, You can build a contrarian strategy that withstands market volatility and capitalizes on mispriced opportunities. Ultimately, contrarian investing is not about blindly opposing the crowd, but rather about having the discipline to act on analysis when sentiment creates opportunity.